us. We think it's a way to avoid too big to fail. We think it's a way to allow these institutions to say, hey, we're this big, but don't worry, we can take care of ourselves. We don't need any more help. And when they're all called not credible, that's a problem. I know that you're in the process now. Do you have any idea what the time frame might be when you're into the second chance?
So last year, the board, working jointly with the FDIC, sent very detailed evaluations of the living wills to the firms and directed the firms to take action to improve their resolvability that were quite specific and quite detailed. We have received those plans. We're evaluating them jointly with the FDIC, and we will be making decisions in the coming months.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. I'm happy, Chair Yellen, to rescue you from the hostile questioning of my Democrat friend over there. Don't take it personally. He's like that way with everybody. But I do actually want to kind of follow on something that he had point of interest and frustration for a number of us is having to do with the speed or lack thereof where there's been some very specific things that were laid out for the Fed to do. And specifically, I want to talk about Section 13.3. The Fed, Dodd-Frank, required the Fed to adopt regulations, quote, as soon as practicable. That was 5 years ago. There have not been final rules implemented to what federal Fed Reserve restrictions you yourself were going to put as far as, and guidelines as far as utilizing 13.3. And so I'm very concerned that that has taken that long. When is that the Fed is going to issue those final rules?
We expect to issue the final rule by the end of this month.
By the end of this month. I will point out to my friend from Massachusetts, just talk nicely and she'll give you a great answer. So my next follow-up question on that is will the rules address the concerns that Senator Warren, Chairman Hensarling, and others have put forward regarding whether your earlier proposal leaves the door open to future Wall Street bailouts?
So let me just say that we regard our emergency lending powers as very crucial powers. It's very important that, God forbid, there should be a future financial crisis. We hope that won't occur. But if there is, that's why the Federal Reserve was created, to provide liquidity when there is a financial panic and lenders are worried about the state of financial institutions and markets generally. Those powers we used during the crisis to keep credit flowing to the economy.
Sure.
So we want to be very careful about what we do.
Sure. And the words used for that are unusual and exigent circumstances, correct? Okay.
That's right.
Well, in my Form Act, we take that and we say we add upon it, raise the bar marginally, I would argue, and we use the language, quote, unusual and exigent circumstances exist that pose a threat to the financial stability of the United States. You've come out, and some of the other Fed governors have come out opposed to that language. Why?
Well, that's when we would use, I'm not sure that we have been opposed. That's when we would use those powers when there are unusual and exigent.
I understand,
but
it's
understood to mean pose a risk to the financial system.
We kind of added two things as a belt and suspenders. That was a phrase you used earlier. One was to include the language that pose a threat to the financial stability of the United States, and certainly informally, that is the pushback that we've gotten. I've met with some of the other Fed governors, and they have pushed back, saying we should not address 13.3. The other one that we have is in my bill, Section 11. We also mandate that in addition to the current requirement of 5 of the 7 Fed board governors to approve a 13.3 usage, that 9 of the 12 district federal bank presidents must also approve. Any concern with the belt and suspenders approach that way?
I think the approach that we have currently that's in Dodd-Frank is quite adequate.
So you do have a concern with adding the district Fed bank presidents?
I might have some concern with that.
What concern?
This has always been a board power to decide when to authorize particular reserve banks to engage in programs through the discount window, emergency lending programs through the discount window.
But you understand there's a bipartisan concern and bicameral concern about how that has been used in the past, and that there is too big of a door open yet for these massive Wall Street bailouts to happen, and that what we are trying to address is, in addition to adequate collateral and solvent borrower definitions, we're trying to make sure that there's not just a check and there's just not a rush to find a solution here, but that we also have the Fed bank presidents in there. So,
Well, Dodd-Frank clearly restricts the way in which this power can be used, and the rule that we finalize will address concerns about the definition of broad-based eligibility, insolvent borrowers, and penalty rates.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you, Chairman Hensherling and Ranking Member Waters. And welcome, Madam Chair Yellen. Thank you for your appearance here today. Please accept my sincere gratitude for your steadfast leadership at the Federal Reserve. The Dodd-Frank Act reforms paved the way for solid and steady economic growth by restoring confidence in our markets. It's one of the pillars of reform, supporting the creating of 13 million private sector jobs for 67 consecutive months, extending the longest running growth streak in our history and reducing the unemployment rate to 5.1%, the lowest since 2008. My first question is as follows. You indicated in your testimony that the Fed has tailored its regulatory and supervisory requirements for regional and community banks. However, I continue to hear from banks of all sizes in Texas and in my congressional district that they're burdened by the regulation and the costly stress tests required. In fact, one regional bank, Emigi Bank of Texas, one of their facilities is in Houston, spent $20 million in its stress tests alone. In your opinion, do our financial regulators currently have the discretion they need to correctly tailor regulatory and supervisory standards, or should we in Congress take action?
So, Congressman, my understanding is that stress tests are required of banks that are $5 billion and above, and the requirements for the smaller banking organizations are very different than those for the larger, above $50 billion organizations, that they're only required to do a company-run stress tests. For the smallest organizations, there's no such requirement. Now, I did say earlier that we don't have as much ability with respect to stress tests to tailor as I think would be ideal. There are smaller banking organizations where we do see costs of having to participate in the stress tests and benefits that are probably not commensurate. So that is an area that we're focused on, where we're tailoring as best we can, but some legislative change to